Think back to 2008 for a second. Imagine thousands of investors opening up their quarterly statements and just feeling this profound, chilling sense of panic.
Oh yeah, absolute terror. Just a brutal reality check for so many people.
Right. Because for years, they had been handing over their life savings to these highly paid, incredibly confident portfolio managers.
The guys in the bespoke suits.
Exactly. And for years, those managers had been reporting fantastic numbers. I mean, 15% returns, 20% returns. They looked like absolute financial geniuses.
Until the tide went out.
Right. When the financial crisis hit, this terrifying reality was exposed. Those managers weren't geniuses. They didn't have some magical skill for picking stocks.
No, they really didn't.
Yeah.
To get those flashy returns, they had just been taking on massive, invisible, catastrophic risks.
Basically picking up pennies in front of a steamroller. And when the steamroller finally accelerated, well, it crushed everyone's retirement.
It's a tragic cycle, and it begs a really crucial question.
Yeah, which is, if a portfolio manager sits across from you in a fancy boardroom and, slides a piece of paper across the table showing a 15% return, how do you actually prove it?
Mathematically, objectively prove it, right?
Right. How do you prove if they are genuinely skilled or just dangerously, terrifyingly lucky?
It really is the ultimate question in modern finance. Because, the stakes are just incredibly high for everyone involved.
Because if you get it wrong, you lose everything.
Exactly. If you falsely attribute a manager's past success to genuine skill when it was actually just, a byproduct of luck or a hidden risk, you're going to allocate capital to a strategy that is ultimately doomed to fail.
It's just a ticking time bomb.
It is. Performance evaluation isn't just about patting someone on the back and writing a bonus check. It is a rigorous, deeply analytical, almost forensic process.
You have to strip away the noise.
Right. You surgically isolate the manager's actual decision-making from just general market movements.
And that is exactly our mission for this deep dive. Today, we are cracking open R24, which is the official playbook on portfolio performance evaluation.
It's dense, but it's so important.
Oh, it is. We are going to take the exact toolkit used by the most sophisticated institutional investors on the planet and basically translate it so that you can understand exactly what is happening with your money.
It's about giving you that X-ray vision.
Yes. By the end of this conversation, you will never look at a mutual fund prospectus or like a financial news segment or even your own 401k statement the same way again.
And that X-ray vision is sorely needed because most investors, they really only ever look at the surface.
They look at the final return number and they just stop right there.
Right. But in institutional finance, as R24 makes very clear, that single number is practically meaningless without context.
Just a number in a vacuum.
Exactly. To get that context, we have to follow a very strict sequential framework. Think of it like a ladder. You can't reach the top without stepping on the specific rungs below it.
Okay, so what are the rungs?
The source material outlines 3 mandatory, interrelated steps for evaluating any portfolio. You have performance measurement, performance attribution, and finally, performance appraisal.
Okay, let's take those one by one. And I want to make sure I really understand the distinction because, those 3 words sound incredibly similar to the average person.
They do, yeah. People use them interchangeably, but they are very distinct.
Right. So step 1 is performance measurement. That sounds pretty straightforward. Just, did my account go up or did it go down?
It is the foundation, yes. Measurement answers the simplest question. What was the portfolio's return? And what was the risk taken over a specific period of time?
Seems easy enough.
But even here, at step 1, things get nuanced quickly. Before you calculate anything, you have to establish whether you are measuring absolute performance or relative performance.
Okay, so what's the difference in the real world?
Well, absolute performance is simply measuring against a fixed target. Let's say a manager's stated mandate is to generate an 8% return per year, maybe to satisfy the payout requirements of a charity endowment.
Right. They need cash to pay out.
Exactly. Measurement in this case is completely binary. Did they hit 8% or didn't they? Doesn't matter what the rest of the stock market did.
So if the market goes down 20%, but the manager promised an 8% absolute return, they better find a way to get that 8%.
Precisely. They can't use a bear market as an excuse. But relative performance, which is frankly far more common for everyday investors and massive pension funds alike, that's about comparing the manager to a benchmark.
Like comparing them to the S&P 500.
Right. Did you beat the S&P 500?
Mm-hmm.
Or do you outperform a specific index of, say, European government bonds? That fundamental distinction, absolute versus relative, dictates literally everything that follows.
I'm trying to picture this. It's almost like looking at a post-game sports
Oh,
analysis.
I like that. Go on.
Like, performance measurement is just staring at the final scoreboard as you walk out of the stadium. It tells you that your team won 24-14.
Right.
That's a relative measurement against the other team. It's absolutely essential information. I mean, you need to know who won, but the scoreboard tells you absolutely nothing about how the game was actually won.
That is a very apt analogy. The scoreboard doesn't tell you if your quarterback threw for 400 yards or if your defense forced 5 turnovers.
Or if the other team just had a spectacularly bad day and kept fumbling the ball out of bounds, you just see the final score.
Exactly. Which brings us perfectly to rung number 2 on the ladder, performance attribution.
Okay, so if measurement is the scoreboard, attribution has to be the detailed player stats.
You nailed it. Performance attribution is the how. It takes that final risk and return number and basically x-rays it.
Peeling back the layers.
Right. It deconstructs the aggregate performance into its underlying key drivers.
Yeah.
So if a portfolio generated a 15% return and the benchmark only generated 10%, we have 5% of excess return.
5% of alpha or active return.
Right. Attribution's entire job is to explain every single basis point of that 5% gap. Was it because the manager bought Apple instead of Microsoft?
Or was it because they held more cash than the benchmark?
Or maybe they placed a massive bet on the Japanese yen. Attribution tells you exactly how the sausage was made.
So it's the forensic breakdown, but I'm assuming you can't just do this haphazardly. Like, if I'm auditing a manager, there must be strict rules for how this attribution is actually calculated.
Oh, there are. They are incredibly strict. According to R24, for an attribution process to be considered valid by institutional standards, it must possess several mandatory characteristics.
Okay, hit me. What's the most important one?
The most critical one is that the model must reflect 100% of the portfolio's risk and return.
Wait, what do you mean by 100%? Wouldn't any basic math formula capture everything automatically?
You would be surprised. In the real world, institutional portfolios contain highly complex instruments. I mean, derivatives, unlisted private equity, bizarre foreign currency swaps.
Stuff that's really hard to price.
Exactly. Some managers might try to use an attribution model that conveniently ignores a highly volatile, highly complex derivative trade just because it's too difficult to model.
Oh, wow. So they just sweep it under the rug.
Right. But
Wow.
if your attribution X-ray leaves out a massive chunk of the portfolio, the entire analysis is completely compromised. It must account for everything.
Okay, so no hiding the ugly, complicated stuff. What else is required?
Secondly, the attribution model must perfectly mirror the manager's current decision-making process. And this is where a lot of valuations completely go off the rails.
I don't follow. How does a mathematical model mirror a human's internal decision-making process?
Let's say you hire a manager because they claim to be an expert in deep, fundamental, bottom-up analysis of small healthcare companies.
Okay, like they read clinical trial data, they interview the CEOs, that sort of thing.
Exactly. They pick the best individual stocks.
Yeah.
Your attribution model needs to be specifically designed to measure their skill at picking healthcare stocks.
Right, because that's literally what I am paying them a fee to do.
But what if halfway through the year, that manager gets totally spooked by the macroeconomy, abandons their healthcare research, and starts making massive leveraged bets on the direction of global interest rates?
Oh, so they just totally changed their strategy.
Right. That is a completely different decision-making process. If you keep using your old attribution model, which was built to measure stock picking, it will spit out total nonsense.
Because it's looking for the wrong thing.
Exactly. It won't capture the massive interest rate risk they are suddenly taking. An attribution model must continuously align with what the manager is actually doing today.
That is fascinating. It's like grading a calculus exam using a grading rubric meant for a French test.
Yes.
If the manager experiences style drift, if they wander away from their stated strategy, the math has to adapt instantly to catch them.
Exactly. So we have measurement, the scoreboard. We have attribution, the detailed explanation of the stats. That brings us to the third and final rung of the ladder, performance appraisal.
The ultimate verdict.
This is where we answer the million-dollar question. We know what the return was, and we know exactly how the manager achieved it. Now, we use professional judgment to decide, was this outperformance due to the manager's active, repeatable skill?
Or was it just sheer, unadulterated luck?
Exactly.
Skill or luck?
But let me play devil's advocate here. Why is it so crucial to distinguish between the two? If my account went up by 20%, Why do I care if my manager was lucky or skilled? Cash spends the same either way, right?
It does spend the same today. But if you are going to leave your money with them for the next 10 years, you have to remember luck runs out. Skill compounds.
Ah, that's a great point. If an appraisal concludes that a fund's massive outperformance was primarily due to a lucky macro event, say, they just happened to own an obscure oil stock right before an unpredictable geopolitical crisis caused oil prices to triple, there is absolutely no reason to expect that manager to generate a similar 20% return next year.
Because they can't predict the next geopolitical crisis.
Exactly. You are paying them a high active management fee for a reproducible skill. If it was just luck, you should fire them immediately and buy a cheap index fund.
So tying this all back to the listener, when you turn on a financial news network or you get that glossy, full-color brochure from your 401k provider, they're almost exclusively feeding you measurement.
Just the scoreboard.
Right. Just up 12% this year. Morningstar 5-star rating. And what we need to do is demand the attribution and the appraisal. We have to understand how the sausage actually gets made.
Precisely. And to understand how it's made, we really need to look at what tools the auditors actually use to pry open the portfolio.
Let's get into the tools.
Reading 24 details 3 very distinct methodologies for conducting performance attribution. They are returns-based attribution, holdings-based attribution, and transactions-based attribution.
All right, let's unpack these one by one. I want to know exactly how we interrogate a portfolio. The text says the first one, returns-based attribution, is the easiest to implement.
It is, yeah.
But it describes the process by saying it, quote, regresses total portfolio returns against major risk factors, end quote. What does that actually mean? Because statistical regression sounds like something that requires an advanced PhD to even grasp.
It sounds intimidating, I know, but the concept is actually quite intuitive. Think of returns-based attribution as trying to figure out what's inside a locked, totally opaque box without ever being allowed to open it.
Okay, so I can't look inside. How do I figure out what's in there?
By shaking it and observing how it reacts to different external forces.
Yeah.
In finance, you take the manager's overall return numbers, say their monthly returns for the last 3 years, and you plot them on a graph.
Just the final scoreboard numbers?
Right. Then you plot the returns of various market factors on the exact same graph. You plot the return of large tech stocks, the return of small industrial stocks, the return of long-term government bonds.
Okay.
Regression is simply a statistical tool that draws a line of best fit to find patterns between those plots.
So let me make sure I'm getting this. If I notice that every single time small cap tech stocks randomly jump by 5%, my manager's locked box also mysteriously jumps by almost exactly 5%.
Yes.
I can statistically infer that the manager must be heavily invested in small cap tech stocks.
Exactly. Even though you have never seen a single physical stock certificate they own, the statistical regression proves that their returns behave identically to a specific risk factor.
That's wild.
You figure out their active bets purely by observing the behavior of their aggregate returns from the outside.
I can actually see a massive appeal to this. Like, if I'm a highly secretive, high-frequency, quantitative hedge fund, I absolutely do not want to give my auditor or my clients a daily list of my exact trades.
Of course not. That's your intellectual property.
Right. With returns-based attribution, I just hand them my monthly performance numbers, and they can run their little regression. It's totally opaque regarding my actual holdings.
It is the absolute standard for alternative investments and secretive hedge funds for that exact reason. But, and this is a big but, as the source text warns, because it is an outside-looking-in approach, it is the least accurate of the 3 methods.
Because it's essentially just an educated guess.
Yes. And worse than that, it can be mathematically manipulated.
Wait, really? How does a manager manipulate a statistical regression?
Oh, it happens. Let's say a manager knows you're evaluating them using a returns-based model that compares them to the S&P 500.
Okay.
They might intentionally go out and buy highly complex, obscure, illiquid derivatives that coincidentally mimic the return pattern of the S&P 500 in normal everyday markets, but carry massive hidden blow-up risks if the market crashes.
Oh, no.
The regression model looks at the clean monthly returns and says, yep, looks like a normal, safe equity portfolio.
It completely misses the toxic waste sitting at the bottom of the locked box.
Exactly, because the regression only looks at historical return correlations. It doesn't read the actual physical, legal contracts the manager signed.
That is frankly terrifying. It's like evaluating an airline pilot solely on whether the plane landed, without knowing they were flying blindfolded and drunk the entire time.
That's a great way to put it.
Okay, so if returns-based is too opaque and way too vulnerable to manipulation, we naturally move to the second type holdings-based attribution. I assume this means we actually finally get to unlock the box.
We do. With holdings-based attribution, you demand transparency. You look at the exact inventory of what the manager held at the very beginning of the evaluation period.
Give me an example.
So if you were evaluating their performance for the month of March, you look at their exact line-by-line portfolio on the morning of March 1st. You see every stock, every bond, every cash position.
Well, that sounds infinitely better than guessing.
It is significantly more accurate because you are analyzing reality, not statistical correlations. You see that on March 1st, they had 30% of their money in healthcare and 10% in energy.
Right.
Then you calculate the return of those specific known holdings over the entire month. You can pinpoint exactly which sector bets worked and which ones failed.
But hold on. Reading 24 brings up a very specific, glaring flaw with this approach, too. They call it the trading effect or the timing effect.
Yes, and it's a massive, massive blind spot for this method.
Let me see if I can articulate this the way I understood it. If I evaluate a manager by looking at their holdings on March 1st, and then I check the final scoreboard on March 31st, I am completely blind to everything they actively did on March 15th.
Precisely. You only have 2 snapshots.
It's like, okay, imagine a nutritionist trying to evaluate a family's diet.
Okay, I'm tracking.
The nutritionist takes a photograph of the inside of the refrigerator on the 1st of the month, and then takes another photograph on the 30th of the month.
Right.
They look at the photos and see a single gallon of milk on the 1st and a single gallon of milk on the 30th. The nutritionist concludes, this family doesn't drink much milk.
I see where this is going.
Meanwhile, the family went to the grocery store 12 times in the middle of the month, bought 20 gallons of milk, drank it all, and just happened to restock right before the second photo was taken.
That is a perfect illustration. If a portfolio manager is highly active, meaning they are day trading, shifting allocations, aggressively reacting to news in the middle of the month, holdings-based attribution completely misses the impact of all that intra-month activity.
It just vanishes from the analysis.
Yes. The mismatch between what they held at the start of the month and the frenetic trades they made in the middle creates a massive unexplained gap in the performance analysis.
So if a manager loses a total fortune day trading GameStop in the middle of the month, but somehow manages to sell it all and buy safe blue chip stocks right before the end of month snapshot, the holdings-based attribution might completely misattribute why the portfolio's return was so terrible that month.
Exactly. They look safe on paper, but they were reckless in reality. The sources are definitive on this. Holdings-based attribution is wildly inappropriate for high-turnover active funds when the evaluation periods are long.
So how do you fix it? Take more photos?
Basically, yes. To mitigate this, you have to tighten the snapshots. Instead of monthly pictures of the fridge, you take daily pictures. But even then, you might miss intraday, minute-by-minute trading.
Which logically forces us to the third and final method, the Holy Grail. Transactions-based attribution.
This is the one that leaves absolutely nowhere to hide. Transactions-based attribution tracks every single trade the manager makes.
Every single one.
Every single one. It captures the exact purchase price, the exact sale price, the exact time of day the transaction occurred, the commission paid, and the exact weight of every asset at every millisecond of the evaluation period.
Wow.
It captures the initial holdings plus every single movement in between.
So sticking with the analogy, it's like installing a 24/7 security camera inside the refrigerator. You see every single drop of milk being consumed.
Yes, it perfectly reconciles the portfolio's return to the exact penny. There's no timing effect, there's no statistical guessing. It is the absolute, unvarnished truth of what happened.
Okay, but if it is the absolute truth and it's the Holy Grail, why isn't every single auditor and institutional investor on Earth just demanding transactions-based attribution? Why even bother with the other two?
2 massive barriers: data latency and staggering complexity.
Okay, break that down.
Imagine a multi-strategy institutional fund managing $50 billion. They have complex algorithms executing thousands of micro trades across global markets every single day. The sheer volume of data is just astronomical.
Right, trying to process millions of trade tickets would be insane.
Exactly. To ingest that data, clean it, reconcile against live market pricing feeds, and run complex attribution models on it, it requires incredibly expensive, specialized software infrastructure.
So it's just too expensive.
For many funds, yes. The cost of implementing true transactions-based attribution simply outweighs the benefit. It is an operational nightmare.
So it's always a trade-off. We have returns-based, which is cheap, easy, but basically guessing from the outside. We have holdings-based, which is a solid middle ground, but suffers from that timing blind spot. And we have transactions-based, which is perfect, but practically prohibitively expensive.
And this is where you, as an investor, can actually use this knowledge.
How so?
If you are paying a 1 or 2% fee for an aggressive active manager who claims their real edge is short-term trading, but they only provide their auditors with monthly holdings-based attribution data, you should see a massive red flag.
Because they're hiding the middle of the month.
Exactly. They're essentially hiding the reality of their most important process from the evaluation.
That is a phenomenal takeaway. You have to demand that the X-ray machine actually matches the disease you're looking for.
Beautifully stated.
Okay, so we understand the 3 basic tools. Now, I want to step into the operating room. I want to take a real portfolio, lay it on the table, and dissect it. And let's start with the asset class everyone is most familiar with, equities, the stock market.
Okay, let's do it. When we evaluate a stock portfolio that has successfully beaten its benchmark, the very first thing we have to do is establish a chain of command. We have to figure out whose fault the outperformance actually is.
Whose fault? I love that phrasing. Usually everyone just wants to take credit for a win.
Exactly. Success has many fathers, right?
Yeah.
But in institutional finance, R24 draws a very hard line between macro attribution and micro attribution. This is a critical distinction based on the hierarchy of decision-making.
Okay, break that down for me. Who handles the macro and who handles the micro?
Macro attribution evaluates the fund sponsor. Think of the sponsor as the board of directors or the massive investment committee of a state pension fund.
The people at the very top.
Right. These people do not pick individual stocks. Their job is broad asset allocation. They decide the big picture. We are going to put 60% of our billions into U.S. large cap equities, 30% into European bonds, and 10% into emerging markets.
Okay, so the sponsor is setting the grand strategy. And micro attribution.
Micro attribution evaluates the actual portfolio manager. The sponsor hands that 60% of the money to a portfolio manager and says, go invest this in U.S. large cap equities.
So they're the ones in the trenches.
Exactly. The portfolio manager is deciding whether to buy Apple or Google, Ford or Tesla. Micro attribution measures their specific day-to-day tactical decisions.
So if the pension fund has a terrible year overall, macro attribution tells us if the board of directors ruined everything by having too much money in Europe, while micro attribution tells us if the portfolio manager ruined everything by picking terrible stocks in America.
Precisely. You have to know who to fire. And to conduct this micro attribution specifically for equity managers, the global industry standard is a set of arithmetic formulas known as the Brinson models.
The Brinson models.
Right. If you are evaluating an equity manager, you're almost certainly using a variation of this. You'll see it referred to as the BHB model, named after its creators, Brinson, Hood, and Biebauer, or the refined BF model, named after Brinson and Fachler.
I really want to spend some real time on this because the Brinson model is essentially the secret decoder ring for the entire mutual fund industry.
It really is.
The sources explain that the Brinson models take a manager's active return, which is just their return minus the benchmark return, and slices it into 3 very distinct measurable buckets. And those buckets are the allocation effect, the selection effect, and the interaction effect.
Let's define the reality of what those buckets actually represent in the real world, starting with the allocation effect.
Okay.
This measures the manager's macro-level decisions within their specific mandate. It evaluates their sector or style weighting.
Give me a concrete example so I can picture it.
Let's say the benchmark for this manager is the S&P 500. The benchmark dictates that 20% of the portfolio should be in technology stocks and 10% should be in utility stocks.
Just based on the market cap.
Right. But the manager looks at the economy and makes an active decision. They think tech is going to boom and utilities are going to crash. So they overweight tech, putting 30% of your money there, and they underweight utilities, dropping it to 5%.
So they are placing a macro bet on the sectors themselves, regardless of what specific tech or utility companies they actually end up buying.
Exactly. If technology ends up outperforming the overall market and utilities underperform, that manager's decision to overweight tech generated a positive allocation effect. They rode the right wave.
Okay, that makes total sense. That's top-down thinking. So what is the selection effect?
The selection effect isolates pure stock picking skill, completely divorced from the sector weights. We look inside that technology bucket.
Just at the stocks themselves.
Right. Even if the manager had just kept the benchmark's 20% weight in tech, we want to know, did they buy the best tech companies? Did they buy the NVIDIA that went up 100%? Or did they buy the legacy hardware company that went bankrupt?
So if the stocks they picked beat the average return of the tech sector, they generated a positive selection effect.
Exactly.
So allocation is picking the right ocean, selection is picking the fastest boat in that ocean.
That is a fantastic way to put it.
But then we get to the third bucket, the interaction effect. And I have to be honest, when I first read through the source material, this felt incredibly confusing.
It throws a lot of people off.
It mathematically states that total active return equals allocation plus selection plus interaction. But interaction sounds like a statistical dumping ground. It sounds like the leftover change the accountants just couldn't figure out where to put. What physically happens in the real world to create an interaction effect?
It is the mathematical glue, yes,
Hmm.
but it absolutely represents a physical reality. It measures the combined impact of the manager's allocation and selection decisions working together or working against each other.
Let's go back to our sports analogy to see if we can make this click.
Let's try it.
Uh-huh.
Think of the portfolio manager as a basketball coach. The selection effect is the coach's ability to draft incredibly talented players. They draft a phenomenal three-point shooter. That is brilliant selection.
Okay, great scout.
Right. The allocation effect, then, is the coach's strategy for how they distribute playing time on the court.
Okay, so what is the interaction?
Imagine the coach drafts that phenomenal three-point shooter, so great selection, but then, inexplicably, only lets that player on the court for 2 minutes a game.
Oh, so they heavily underweighted their best asset.
Exactly. That's terrible allocation. The interaction effect measures the wasted potential. It captures the fact that the manager had a brilliant stock pick, but because they didn't allocate enough capital to that sector, the brilliance was basically muted. Or, conversely, if they overweighted a sector where their stock picks were absolutely terrible, the interaction effect penalizes them doubly. It ensures the arithmetic of the returns balances perfectly.
That makes so much sense now. Okay, let's put some hard numbers to this. The sources provide a really illuminating mathematical example of a growth and value fund. I want to walk through this slowly because it proves why this entire Brinson process is so necessary.
It's a great example. Let's look at the numbers.
So, you are an investor. You open your quarterly statement. Your portfolio returned 14.5% for the year. The benchmark returned 14.0%.
Okay.
So the manager beat the market. The active return is a positive 0.5%. If I'm a normal retail investor, I look at that and think, my manager's fantastic. They beat the market. I'm totally happy to pay their 1% fee.
Of course, you see a win. But when institutional analysts run those exact same returns through the Brinson model, the X-ray reveals a deeply concerning story about how that 0.5% was actually achieved.
Right. Let's dissect that 0.5% active return into the three buckets. According to the text example, the allocation effect was a negative 2.00%, the selection effect was a positive 0.80%, and the interaction effect was a positive 1.70%.
Stop right there and look at that first number. The allocation effect was negative 2.00%.
I really want the listener to grasp the gravity of that negative 2%.
What that negative 2% means in reality is that this manager made astronomically bad macroeconomic calls. They put the fund's capital into the wrong sectors at the exact wrong time.
So they were actively hurting the portfolio.
Yes. Their decision to try and time the market or rotate sectors actively destroyed 2% of the portfolio's potential value, compared to just passively tracking the benchmark.
They were essentially harming the client with their big picture strategy. But wait, the overall return was still positive 0.5%. How did they survive that massive mistake?
Because of the other two buckets. Their pure stock picking skill, the selection effect, was a positive 0.80%. And the interaction effect was a massive positive 1.70%.
So those two buckets saved them.
Exactly. Those two things combined to desperately bail water out of the sinking boat, dragging the overall active return from a negative 2% all the way back up to a positive 0.5%.
Think about the implications of that for a moment. Without the Brinson model, you, the client, just see a 0.5% win. You might sit in a meeting and say, wow, this manager is a genius at reading the global economy. Look at how they navigated the markets.
But the math proves the exact opposite. The manager is terrifyingly bad at sector allocation.
It reveals a profound inefficiency. Like if that manager had simply recognized their own weakness, given up on trying to predict which sectors would win, passively held the benchmark sector weights, and just focused all their energy on their genuine skill, which is stock picking, the client's overall return would have been massively higher.
Exactly. The manager is literally fighting against their own bad macro decisions.
That is mind-blowing, and if you didn't force them to provide this attribution, you'd never, ever know. You would just blindly trust the scoreboard.
Which is exactly why institutions mandate this process.
Okay, so the Brinson model is clearly a masterpiece for analyzing stock pickers. But here is the next logical problem. Equities are just one asset class. What happens if I don't own stocks? What if I hand my life savings to a bond manager?
If you try to run the Brinson model on a fixed income bond portfolio, the math will spit out total nonsense.
Why is that?
Because the Brinson model is built on the fundamental premise of analyzing stock selection within distinct sectors. In the bond market, while corporate bonds do have sectors, the overwhelmingly dominant force dictating whether a bond goes up or down isn't the sector, it's the direction of global interest rates.
Right, because if the Federal Reserve raises interest rates, almost all existing bonds lose value, basically regardless of what sector they are in.
Exactly. A bond manager's primary weapon isn't stock selection, it's managing interest rate risk.
So how do we evaluate a bond manager if Brinson doesn't work?
We use a completely different framework called fixed income attribution. And the primary tool within that is something called exposure decomposition.
Unpack exposure decomposition for me. What exactly are we exposing?
We're exposing the manager's bets on time. In fixed income, time is measured by duration. Duration is essentially a mathematical measure of how sensitive a bond's price is to interest rate changes.
Okay.
The longer the duration, say a 30-year government bond, the more violently its price will swing when interest rates change. A one-year bond barely moves at all.
It's like a seesaw. The further out on the plank you sit, the longer the duration, the wilder the ride when the pivot moves.
That's a great visual. So instead of breaking the portfolio into buckets like tech or healthcare, exposure decomposition breaks the portfolio into duration buckets.
So sorting them by time.
Right. You might have a short duration bucket for bonds maturing in 1 to 3 years, a medium duration bucket for 3 to 7 years, and a long duration bucket for 10 years plus.
And then what? We just look at the buckets.
Then within those time buckets, we slice it one more way. We separate government bonds from corporate bonds. Government bonds are generally considered risk-free regarding default, while corporate bonds carry credit risk, which is the risk the company goes bankrupt.
And corporate bonds have to offer a higher yield to compensate for that danger, right?
Exactly.
Okay, so we've built our new X-ray machine. How does it catch a bad manager in the real world?
Okay, imagine a bond manager absolutely crushes their benchmark for the year, beating it by 3%. In the fixed income world, 3% outperformance is massive.
You want to know if they're a genius?
Right. Exposure decomposition instantly reveals how they did it. Let's play out 2 scenarios. Scenario A. The attribution shows that the manager correctly predicted that the Federal Reserve was going to aggressively cut interest rates. Knowing that rate cuts make long-duration bonds skyrocket in value, the manager expertly shifted all of your capital out of the short-duration bucket and piled it into the long-duration bucket right before the cut.
That sounds like brilliant tactical macro management.
It is. Pure skill. Now, scenario B. The manager had absolutely no idea what interest rates were going to do. Instead, to get that 3% extra return, they just moved all your money out of safe government bonds and bought the absolute junkiest, highest risk corporate bonds they could find in the short duration bucket.
Oh, they just reached for yield.
Exactly.
Wow, so they just took on massive credit risk. If the economy had hiccuped, half those companies would have defaulted and my retirement would be totally gone.
Precisely. Both Scenario A and Scenario B resulted in the exact same 3% outperformance on the scoreboard. But exposure decomposition proves that one manager is a tactical forecaster and the other is just a gambler playing Russian roulette with your credit risk.
That is exactly why the scoreboard isn't enough. The sources also briefly mention yield decomposition as another fixed income tool. How is that different from what we just talked about?
It's just a different mathematical lens.
Yeah.
Yield decomposition breaks the bond's total return down by mathematically separating the steady income you receive, the coupon payments, from the actual price change of the bond itself, which is driven by duration, in yield to maturity.
Ah, so it's a more technical way to isolate if the manager makes money by clipping coupons or by aggressively trading bond price volatility.
Exactly. Just another way to X-ray the strategy.
Okay, so we've conquered stocks with Brinson and bonds with exposure decomposition, but the financial industry loves to invent new, insanely complex things. What about these quantitative, algorithm-driven funds?
The quants.
Right. What if a manager isn't picking stocks or analyzing bonds, but is instead explicitly running a factor fund?
This requires arguably the most fascinating tool in modern finance. When an equity manager abandons traditional stock picking and instead tries to capture broad, systemic market anomalies, called risk premiums or factors, we evaluate them using the Carhart model.
I love the Carhart model. When I was reading the source text, I kept picturing it like a 23andMe genetic DNA test, but for your portfolio.
That is a brilliant way to conceptualize it. It really is like looking at the DNA.
Think about it. You might hire a portfolio manager who wears bespoke suits, works in a mahogany office, and charges a massive fee. They tell you they are crafting a unique artisanal portfolio of stocks just for you.
A very expensive story.
Exactly. But the Carhart model comes in, takes a swab of the portfolio's DNA, and runs it through the lab. And it might prove that your artisanal manager isn't doing anything special at all. They're just aggressively buying prepackaged genetic characteristics that literally any computer could buy.
That's spot on. The Carhart model strips away the illusion of genius by calculating excess returns based on 4 very specific, scientifically proven factors. If a manager is outperforming, Carhart determines exactly how much of that outperformance is simply due to these 4 genetic traits.
Let's walk through the 4 factors because I want to understand the economic reality behind each one. The first one is RMRF.
RMRF stands for Return of the Market minus the Risk-Free Rate. This is just the baseline. It basically measures how much return the manager got simply by being exposed to the general stock market rather than sitting in safe treasury bills.
So it's just the beta. It requires zero skill to capture. You could just buy an index fund.
Exactly. Zero skill.
Okay, the second factor is SMB, small minus big. What's the logic there?
This measures the size factor. Historically and economically, smaller companies are inherently riskier, less established, and less liquid than massive megacorporations. Because they are riskier, investors naturally demand a higher potential return to hold them.
That makes sense.
So over long periods, small-cap stocks tend to generate a premium over large-cap stocks.
Yeah.
The Carhart model checks to see if your manager's outperformance is just because they tilted the portfolio heavily toward tiny, risky companies.
Got it. Factor 3 is HML high minus low.
This is the value factor. It compares companies with a high book value to price ratio, meaning the stock looks very cheap compared to its actual accounting assets, against companies with a low ratio, which are typically your expensive growth stocks.
So it's looking for value.
Right. Historically, buying cheap, beaten-down value companies generates a premium because you are taking on the risk of companies that might be in distress.
Okay, and the final factor, the fourth one, is WML winners minus losers.
This is momentum. This factor captures the behavioral anomaly that stocks which have been going up recently tend to keep going up in the short term, and stocks that are falling keep falling.
People just follow the herd.
Exactly. It's a momentum trade.
Okay, so let's apply the DNA test. Let's say my expensive bespoke manager beats the market by 5%. But you run the Carhart model, and the math shows that 4.5% of that outperformance is perfectly explained by the SMB and WML factors. What does that actually mean for me as the client?
Simply put, it means you're being ripped off.
Wait, really? Even though I made money?
Yes, because you are massively overpaying for the method. The manager's entire skill is just systematically buying small-cap stocks that have upward momentum. You do not need a highly paid human being in a mahogany office to do that.
I could just do that myself.
Exactly. You can log into a brokerage account, buy a passive small-cap momentum ETF for a fee of 0.1%, and get the exact same result. The Carhart model reveals that the manager has no true alpha, no unique, unreplicable skill. They're just harvesting generic factors and charging you a premium for it.
It's like finding out a Michelin star chef is charging you $200 a plate. But all they are doing is microwaving a very specific brand of frozen dinners. The food might taste okay, but you're overpaying for the service.
That is exactly what is happening in a lot of these funds. And the sources are very clear that whether you are using Brinson, exposure decomposition, or Carhart, all of this return attribution falls completely apart if you don't simultaneously conduct risk attribution.
Why? Isn't isolating the return enough to know if they're good?
You cannot look at return in a vacuum. Risk attribution must parallel return attribution. You need to see the cost of the return. If a manager generated 2% excess return, but to do so, they tripled the volatility of the portfolio and took on massive downside risk, that needs to be mathematically quantified.
Oh, I see.
We use metrics like tracking error, which is essentially measuring how far off the leash the manager is allowed to run from the benchmark. If they have massive active return but zero tracking error, something is wrong with your math.
Okay, so we have built this incredible surgical toolkit. We have the Brinson model slicing up equity decisions. We have duration buckets for bonds. We have the Carhart DNA test for factors. We are ready to expose the frauds and crown the geniuses.
They have the tools, yes.
But here is where the entire house of cards can instantly collapse. If we mess up this next step, every single piece of math we just talked about is totally, completely worthless.
Ah, you are talking about the benchmark dilemma.
Yes. The golden rule of data science applies here with terrifying consequences. Garbage in, garbage out.
It's the absolute truth. If you build a flawless Carhart model, but you feed it the wrong benchmark, the resulting active return you were analyzing is what the industry calls a misfit return.
Misfit return. I like that.
It is an illusion. If you are trying to evaluate a manager who only buys European tech stocks, but you mathematically compare their performance to an index of American utility bonds, your appraisal is going to be total, unadulterated garbage.
Right. So how do we find the right yardstick? The source text outlines a few categories of benchmarks, and the first one seems highly specialized liability-based benchmarks.
These are highly specific, yes, and primarily used by massive institutional investors that have legally defined future payouts to make. The classic example is a defined benefit pension plan for, say, a state's teachers or firefighters.
Right. They know exactly how many firefighters are retiring in 2035 and exactly how much cash they need to mail out every single month.
Exactly. For a pension fund like that, their goal isn't just beat the stock market. If the S&P 500 goes up 30%, but inflation goes up 40%, the pension might still go bankrupt.
Wow. Yeah.
Their benchmark is a mathematical model of their future liabilities. The text notes that this heavily limits their investment choices because they cannot afford a massive 40% stock market crash right when they need to make payouts. Their portfolios, and therefore their benchmarks, are heavily weighted toward nominal bonds, inflation-adjusted bonds, and highly stable dividend-paying stocks.
Okay, but for the rest of us, retail investors, 401k holders, standard mutual funds, we generally use asset-based benchmarks, right?
Yes, these are the yardsticks we hear about every day on the news. Broad market indexes like the Russell 3000, style indexes like a large-cap growth index, or even custom security-based benchmarks built to exactly mimic a manager's specific investable universe.
But here is where the sources point out a massive, pervasive trap in the industry. And I want to push back on this because when I first read it, it felt completely counterintuitive to everything we learn about competition. The text explicitly warns against the median manager trap.
Oh, yes. It is a very common pitfall, especially among investment committees.
Here is my logic. Let's say I'm running a university endowment. I want to hire a manager to invest in European equities. Why wouldn't I just take the returns of all 500 European equity managers in the world, find the guy exactly in the middle, the median, and use him as the benchmark?
It sounds reasonable, right?
Yeah. If my manager beats the median guy, isn't beating the average the literal definition of winning?
It sounds incredibly logical. It appeals to our competitive nature. But it completely, utterly fails the fundamental academic tests of what constitutes a valid benchmark.
Why? I don't get it.
Think deeply about what a benchmark is actually supposed to represent in the evaluation process. A benchmark represents the passive alternative. It is the default option. It is the exact thing you could have easily invested in if you had decided not to hire the expensive active manager.
Okay, I'm following.
Can you, on January 1st, go to a broker and say, I would like to invest $1 million in the median manager?
Oh, no, because I don't know who the median manager is going to be yet.
Exactly. The median manager is an abstract ex-post concept. You only know who the median manager is after the year is completely over and everyone has reported their returns.
That makes perfect sense.
A valid benchmark must be specified in advance, so the manager knows the rules of the game, and it must be an investable passive alternative that you could actually buy. The median manager is neither. It cannot be specified, and it cannot be invested in.
That makes total sense when you frame it as the passive alternative. Like, I can buy an S&P 500 index fund on January 1st for practically zero fees. Therefore, the index fund is a valid benchmark. The median manager is just a statistic for a PowerPoint presentation, not a valid performance benchmark.
Precisely. Now, if you want a real headache, try benchmarking hedge funds.
Yeah, the text notes that benchmarking alternative investments is notoriously difficult. Why is it so much harder than stocks or bonds?
Because hedge funds are explicitly designed to not act like the broad markets. They are designed to have low correlation to traditional assets. A hedge fund might be shorting stocks, trading obscure weather derivatives, exploiting microsecond arbitrage in the currency markets, or a combination of all three.
So comparing a complex, market-neutral algorithmic hedge fund to the S&P 500 is completely meaningless.
It's worse than meaningless. It's actively misleading. Because of this, hedge fund benchmarks often have to be absolute return targets, like we promise to deliver the risk-free treasury rate plus a 5% premium, regardless of what the stock market does.
Sounds tough to track.
It is. Sometimes they try to use highly customized peer universes, but as Writing 24 points out, those indexes suffer from terrible survivorship bias.
Survivorship bias, meaning if a hedge fund blows up and goes bankrupt, it just stops reporting its returns to the database. So the average return of the peer group looks artificially high because it only includes the survivors.
Exactly. It makes benchmarking alternatives a very, very murky landscape.
Okay, let's summarize the journey so far. We have measured the raw return, we avoided the median manager trap, and established the perfect investable benchmark. We ran the attribution math, using Brinson or Carhart, to x-ray the portfolio and isolate exactly how the manager made their active decisions.
Right. We've done the hard work.
Now, we arrive at the absolute peak of the mountain, the final verdict, Section 6 of the source material appraisal and navigating the downsides.
This is it. This is where we definitively separate the skilled from the lucky. And more importantly, this is where we determine if a manager is actually safe to invest with over a full economic cycle.
Because it's easy to look like a genius in a raging bull market when a rising tide lifts all boats. The true test of a manager's skill, the real appraisal, often reveals itself when the world is on fire.
Absolutely.
And this is where we turn to one of my absolute favorite metrics, capture ratios.
Capture ratios are elegant because they tell a story about asymmetric performance. They measure how a manager behaves relative to the market in two distinct environments, when the market is going up and when the market is crashing.
Let's walk through the exact math from the text because it is so illuminating. Let's say we are looking at an up market. Times are good, the economy is booming. During this period, your manager earns a 4% return. The benchmark in that same period earns 3%.
Okay, so we calculate the upside capture. It is simply the manager's return divided by the benchmark's return. 4% divided by 3% gives us an upside capture of 133.3%.
What does that tell me as an investor?
It means the manager captures more than 100% of the market's positive momentum. For every dollar the market makes, your manager makes $1.33. They are outperforming when times are good.
Sounds amazing. Sign me up. But then a recession hits. The market crashes. In this down market, the benchmark loses 8%. Your manager, however, only loses 4%.
Now we calculate downside capture. -4% divided by -8%. That gives us a downside capture of 50%.
So the manager only absorbed half of the market's pain.
Exactly. And to get the final single number capture ratio, you divide the upside capture by the downside capture. So 133.3 divided by 50 equals a capture ratio of 2.67.
Okay.
As a general rule, a ratio greater than 1 indicates a manager is adding value asymmetrically. They're giving you more of the upside and less of the downside.
Now, here's something I want to unpack. When you talk to institutional investors or you read the advanced literature, they often seem to obsess over that 50% downside capture even more than they care about the 133% upside capture.
They do, yes.
Why? If I'm an investor, wouldn't I just want a manager who swings for the fences and makes me the most money possible on the upside?
It all comes down to the brutal, unforgiving math of compounding. Losses damage a portfolio geometrically worse than gains help it.
Explain that math to me.
Okay, if you have a $100,000 portfolio and a reckless manager loses 50% of it in a crash, you now have $50,000.
Right. Half my money is gone.
To get back to where you started, just to break even at $100,000, you don't need a 50% gain. You need a 100% gain on that remaining $50,000.
Oh.
Earning a 100% return could take a decade. But if a skilled manager with great downside capture protects your capital and you only drop 10%, Recovering from a 10% loss is relatively easy.
That makes total sense.
A manager who protects capital during a crash radically alters the long-term compounding trajectory of a portfolio. Limiting downside volatility is the quiet, unglamorous secret to massive long-term wealth accumulation.
Which perfectly transitions into another vital risk metric the text covers: drawdowns.
Yes, the text defines maximum drawdown as the absolute largest peak-to-trough loss a portfolio experiences during a specified period. It basically measures the worst-case scenario.
And drawdown duration.
Drawdown duration is the time it takes from the very start of that loss all the way through the trough until the portfolio finally recovers to its previous peak.
I want the listener to really reflect on their own psychology and risk tolerance for a moment. Let's look at two hypothetical managers. Manager A has massive upside capture. They regularly beat the market by 10% during bull runs. They look like a rock star.
Everyone loves Manager A during a bull market.
Right. But during a crash, their maximum drawdown is 45%, and their drawdown duration is 6 years. It takes 6 agonizing years of looking at a red portfolio just to get your money back to where it started.
That is emotionally exhausting. Most retail investors will panic and sell at the bottom of that 45% drawdown, locking in the loss forever.
Exactly. Now consider Manager B. Manager B is boring. They only ever beat the market by 1% on the upside. But their maximum drawdown during the worst crash is only 12%, and their drawdown duration is just 8 months.
I would sleep infinitely better with Manager B.
And this psychological reality is exactly why the financial industry developed appraisal ratios. We need single, quantifiable numbers that help us balance return against risk so we can compare Manager A and Manager B objectively. The text lists the big three: the Sharpe ratio, the Sortino ratio, and the information ratio.
The Sharpe ratio is the absolute classic. You will see it on every mutual fund fact sheet. It measures the excess return a manager generates over the risk-free rate and divides it by the standard deviation or total volatility of the portfolio.
What question does it answer?
It answers the question, how much extra return am I getting for every unit of total turbulence I have to endure?
But the sources explicitly mention how these risk metrics can sometimes be gamed or mathematically misinterpreted. There's a specific, fascinating example in the text about a manager complaining that their standard deviation was artificially inflated, which made their Sharpe ratio look terrible even though they were making the client rich.
It is a known, glaring flaw in the Sharpe ratio. Standard deviation, as a pure math formula, penalizes all volatility equally. It doesn't care about direction.
Wait, what does that mean?
It penalizes downside volatility crashing stock prices, but it also penalizes upside volatility.
Wait, so if a manager buys a stock and it violently, unexpectedly explodes upward by 50%, the standard deviation formula views that as a bad thing.
Mathematically, yes. It views it as unpredictability. If a manager has a lot of sudden, massive positive returns, their overall standard deviation goes way up.
And because standard deviation is the denominator?
Because it is the denominator in the Sharpe ratio equation, a higher standard deviation makes the final Sharpe ratio shrink. The manager's Sharpe ratio looks worse, even though the volatility was entirely in the client's favor.
That seems incredibly unfair to a manager who is just really good at finding breakout stocks.
Which is exactly why the industry developed the Sortino ratio. The Sortino ratio fixes this flaw.
How does it fix it?
It uses the exact same numerator excess return, but for the denominator, it only uses downside deviation. It completely ignores upside volatility.
Oh, that's smart.
It only punishes the manager for volatility that actually loses money. It is a much more accurate reflection of what investors actually care about.
I love that. We won't punish you for making us too much money too fast. And finally, we have the information ratio.
The information ratio focuses strictly on active management. It takes the active return, the amount the manager beat the benchmark by, and divides it by the tracking error, or active risk.
The leash we talked about earlier.
Exactly. It answers the question, for every unit of risk this manager took that was different from the benchmark, how much excess return did their rebellion actually generate? It measures the pure efficiency of their active bets.
Okay, we have covered an immense amount of ground today. We started with the simple scoreboard of performance measurement. We climbed the ladder to attribution, learning about the flaws of holdings-based analysis and the dream of transactions-based data.
We unpacked a lot.
We dissected equity returns with the Brinson model, revealing how a negative allocation effect can be hidden by a positive selection effect. We ran the Carhart DNA test to expose managers charging premium fees for cheap factors. We learned why the median manager is a garbage benchmark. And finally, we learned how to appraise true skill using capture ratios, drawdowns, and the Sortino ratio.
It is an incredibly rigorous, demanding process. It requires immense data, strict adherence to logic, and constant vigilance against statistical manipulation. But it is the absolute only way to protect capital from the illusions of luck and hidden risk.
Which leaves us with a final provocative thought. Built right into R24 was a brief, almost passing mention of something called the lasso technique.
Ah, yes, the lasso technique.
It's described as a machine learning algorithm used to evaluate high-frequency market forecasting by taking hundreds of variables and mathematically shrinking them down to only the most significant ones.
Right, it's AI entering the chat.
Exactly. And it got me thinking about the future. As quantitative models like Carhart get better and better at isolating exact factors, and as artificial intelligence and machine learning algorithms get exponentially better at predicting short-term market movements and running real-time, transaction-based attribution,
I see where you're going with this.
will we eventually reach a point where the very concept of active management skill is completely eradicated?
That is the existential dread keeping the active financial industry awake at night.
Right. Will perfect AI-driven attribution one day prove that all outperformance is just a manager taking on a hidden, unnamed risk?
It's entirely possible.
If an algorithm can perfectly attribute every single basis point of a 15% return to a specific replicable factor, maybe a factor we just don't even have a name for yet, then there is no magic left. The portfolio manager in the mahogany office isn't a genius. They're just a biological, risk-taking mechanism that a computer could replace for a fraction of the cost.
It forces us to ask the ultimate philosophical question in finance: is alpha, that true, pure, uncorrelated human skill, actually real? Or is all alpha just beta that we haven't figured out how to measure yet?
Something to chew on the next time someone in a nice suit slides a piece of paper across the table and promises you market-beating returns. Are they a financial genius, or is your diagnostic X-ray machine just broken? We'll see you on the next deep dive.